Hello and welcome to the latest Insider interview. Our guest today is Michael Matthews, the manager of the Invesco Sterling Bond Fund. Michael, thanks very much for coming into the studio.
Morning.
Bonds can often be a tricky area for retail investors to understand. So to start with, can you explain what bonds are and how they typically fit into portfolios?
I think bonds are much better known than when I first started. I started working in the fixed income team in 1995, and I think then, actually even myself, I didn't know what a bond was, and I think most people thought of bonds, or thought when they were thinking about investing, they were thinking cash or equities. People didn't think about bonds. In fact, in those days, you didn't even have a European high yield market. But bonds are essentially, it's a tradable loan. It's so to either a government or to a corporate, where you have an agreed term when it's issued, and you'll have either a fixed coupon or a floating rate. With a government bond, you'll have interest rate risk. So depending on what markets are doing, what central banks are doing, will adjust will impact the interest rate risk. And then you'll also have credit risk. So if you invest or lend to corporates, there'll be a credit risk component on side of that.
How do different market conditions affect the prices of bonds?
Well, it depends on your risk appetite. So as I just said, there's two components. There's the interest rate risk or the credit risk. And there's a huge risk spectrum on the credit risk. So you can have very risk-free. So you can have, well, if they are risk-free these days, but you can have government bonds. Historically, they would have been at the upper end of the credit ratings. So all bonds that are issued would have or often have a credit rating by the rating agencies. So you start with a AAA, which are considered to be kind of very risk-free, and then you go down AA, single A, triple B, and that's the investment grade universe where the chance of default is very remote. And then you go into high yield, so double B, single B, triple C. So with a bond, if you're looking at the governments or the very good quality investment grade, a lot of the time you're thinking about interest rate risk, whether central banks are going to be cutting rates, whether duration's is going to be working. If inflation is falling, then central banks would often be cutting, and then there's a chance if rates are being cut, bond prices will often be going up because yields will be falling. So you want some duration risk or interest rate risk in the portfolio. If you're thinking about more like equities on the credit side, if economies are doing well and spreads are wide, and you think credit quality is going to improve, then you want more credit risk in the portfolio where you get a bit more yield over the risk-free. What we had, I guess, in more recent times where inflation has been picking up, you'd be much better off in the credit risk component than you have in the interest rate risk component. But really, I think for investors, you've got to be thinking about the two. And for a diversified portfolio, quite often having some interest rate risk in the portfolio in normal markets would not be correlated with equity risk or credit risk. So if you have a risk-off period or economies starting to weaken, then the interest rate component or the government bond side could probably make you money when equities are losing you money.
What bonds go into your portfolio and what opportunities are you finding today?
Well, our portfolio has a pretty broad remit. It's a flexible sterling investment grade portfolio. It has to be 70% in IG, and we try to change the structure of the portfolio depending on our view of markets. At the moment, credit spreads are pretty tight. I think sterling investment grade credit spreads are about 100 basis points, and I think over the last 20 years they probably averaged around 150, 160. Probably broadly speaking, we think of credit spreads being for investment grade between 100 and 200 basis points. So you want to be buying them at the wide end and having less of it when they're tight. But all-in yields are relatively attractive because risk-free rates are high. So gilt yields at the moment, depending where you're on the curve, vary between 4.25% and 5.25%. So if you go to the longer end of the UK curve, that gives you 5.25%, and add on a bit of a credit spread, you can add a bit of quite a nice yield to a portfolio without taking too much credit risk. This hasn't necessarily worked that well in recent times. As I said, credit risk, equity risk has been doing better, but I think now you can get yields that I guess historically aren't that dissimilar to what you'd get in AT1 or high yield without taking too much credit risk, but you are taking duration risk. So actually the portfolio is as defensively positioned as it has been. The 30% So the 70% we have to be invested in IG credit, this 30% risk bucket. Quite often we would use it to have high yield or AT1s. At the moment, we're using it to have cash or governments to have the portfolio a bit more de-risked.
What's the yield on the fund at the moment? And can you explain the different types of yields that someone might find on a fact sheet?
Depending whether you're looking at running yield or redemption yield, I think the running yield is probably just over 4, and the redemption yield I think is about 5.25. And I guess probably some of the listeners will be thinking, well, what's the difference? Where with a running yield, it purely is the coupon divided by the price. And obviously we've been through a relatively challenging period for fixed income, and a lot of the bonds that were issued 5, 6, 7 years ago are now trading at a discount to a par. So the redemption yield will be higher. So because you'll have some capital gain. So let's say a 4% bond trading at 80, the flat yield would just be the income divided by price, which give you a yield of 5%. The redemption yield, you would capture the discount to par, so the 20 points between the 80 and 100 that you get redemption. Let's say it's a 10-year bond, you then get another additional 2 points per year. I'm giving you in kind of simplistic terms because obviously there's actually a present value of cash flow, so it's not exactly that, but redemption yield. And I think for most bond funds at the moment, when you're looking at them, the redemption yield will be higher because lots of the funds, individual bonds are at lower price. I think for our fund, the average bond price is probably around 90 at the moment.
It's the Invesco Sterling Bond Fund, but can you invest internationally as well, and do you?
We're having this interview, probably not the best time for me to be banging the table telling about all the exciting things that we're doing. So it has to be hedged back to sterling, and it has to be 70% investment grade. Other than that, the fund has a lot of flexibility. So if we were having this conversation a few years ago, we'd probably be talking about the allocation to US credit that we had. Or actually, maybe if we went back to probably 2019, 2020, 2021, actually, you could go back to the Brexit vote. We had quite low levels of UK interest rate risk because gilt yields were very low, the lowest, obviously not as low as bonds, but gilts were relatively low. And we were adding bonds, US dollar bonds, because they were yielding higher. It's more liquid market. You could pick up a bit of yield and you had more liquidity, and then hedging the currency back. And we're doing the same in euros. It's all international. Most of the sterling market is international issuers. We don't look at UK-based companies. At the moment, we have a fund that's purely in sterling credit, but it is still from global issuers.
What are the advantages of owning a bond fund like yours over owning gilts directly, which is something we've seen as a very popular theme at the moment among our customers?
Yeah, I know lots of people are looking at gilts, especially if for the low cash price bonds, where there's a tax advantage for some people outside of a tax wrapper. But for an investor looking at the Sterling Bond Fund, I think the advantage you get, one is we have credit risk in the portfolio, so you're getting that additional yield for having the corporate risk rather than having the gilt risk. I think looking back, it's been a challenging period for active fixed income managers versus passive, but I think as we're going into a more challenging environment, I think active management, where we manage the duration risk and the credit risk through the cycle. So at the moment, as we were just discussing, the portfolio is de-risked because we think credit spreads are relatively tight, but we've got a bit of duration because we think actually duration is giving us a bit of yield. If you were just buying an individual bond or a gilt, you don't have someone taking that active view on whether now's the right time. If you're buying it and holding it to maturity, you know what you're getting now, whether it's a good entry point or not. I think for us, we're very focused on whether we're getting paid to take the risk. Yeah. Really, what we want to be doing in an ideal world is to be buying bonds when spreads are wide. You're getting overcompensated for the risk you're taking, but the market's quite nervous about the risk. And then in a more benign backdrop, the spreads can tighten back in. I think what investors get when they're buying the Sterling Bond Fund, if you look back, I know you're probably not allowed to say it, if you look back at history as being the guide, we've had a good record of buying when spreads are wide, but also at the same time being de-risked when we think spreads are tight. So you're getting someone that actively manages the portfolio for you.
Michael, thanks very much for coming in.
Thank you.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.